Well, your title said a strong 2022, but maybe 2023 has not been off to a best start. With me today is Richard Halle. He manages M&G's European Strategic Value Fund. Richard, welcome and thank you for taking your time. Also your fund won the Best European Equity Fund with the Morningstar Award, so congratulations to that. And my first question to you, when you look back at those last few months, what have been the key drivers for value titles?
Thanks, Anja. Yes, I think a good place to start is to contrast the shock we had in 2020 with the shocks that we had in 2022. So the shocks in 2020 really magnified all the very powerful long-running trends which were in place since the global financial crisis, which led to growth doing really well and value doing not so well. So things like, lots of quantitative easing, ultra-low interest rates, digitization, etc. In contrast, the shocks in 2022 put an end to a lot of those long-running trends, or in fact reversed a lot of them. And that was really exciting for value investors because we think that if that does signify a regime change, then it's almost axiomatic that the sorts of stocks that did well in the last 10 years are going to be very different to the types of stocks that are going to do well in the next 10 years. And that is really what happened in 2022 with value doing so well. Now, it's not always a straight road. And in 2023, as you say, growth has made a bit of a comeback. As we've seen, a lot of that driven by the collapse of SVB, which saw a flight to quality, also the incredible improvements in artificial intelligence we've seen, which have brought a lot of the technology stocks back to focus. And to be perfectly frank, as well, a lot of the large cap growth stocks in Europe have delivered spectacularly good results this year. So, fully justify doing well. But we still think the thesis of regime change and different stocks doing well is intact. And, we can see that in many areas. We can see that, for instance, China has been really strong fuel for a lot of the growth stocks over many, many years. And that growth story looks to be like it's not going to be that strong. And the rebound has not been as strong from China. We've also seen a lot of the old structural growth stocks actually doing really well this year. So areas like the banks, which have been structurally declining for a long time, have actually delivered fantastic results this year. So we've seen that in quite a few areas. And finally, the thing we always like to think about is, are we still finding lots of really good new ideas which we can put into the portfolio to make good money for our clients? And yes, we can. And so that gives us a lot of hope for generating good performance from value in the medium term.
Now, you already mentioned different regions. Now, focus on Europe. What makes it interesting? What does Europe make interesting for a value investor?
I would say this, but I think Europe is by far the most interesting place to be a value investor. If you're in the US, you're historically you have been up against a big headwind from some of those big mega cap global monopoly type stocks, which have made life tough for value investors. And also, America is one country. Some of the great things about Europe is not one country. It's a collection of lots of different countries, all with different regulatory regimes, different cycles, different behavioral biases, different national psychologies, different politics, etc. And all that complexity really helps create disturbances and anomalies for value investors to get hold of. And Europe, despite sort of maybe not being the growth engine of the world, still has a number of phenomenal companies within it. There's lots of opportunity to get involved.
Well then, would you mind sharing some of those company names with us and some of those ideas that you pursue?
Absolutely. I think one area which sort of typifies this regime change concept that we've started to get involved in this year is the real estate sector. So, we haven't really had any real estate stocks for a number of years because in a zero interest rate regime, everybody wanted real estate. They needed to get yield from somewhere and they couldn't get it from the bond market, and getting that from the real estate sector was where everybody went to. And in addition, those companies could all get debt almost for free. So they loaded up their balance sheets with lots of debt. And so equity investors in real estate did very, very well for a long time. Now, obviously, that's all reversed now. You've seen failed rights issues, difficulties refinancing, management changes, and everybody's running scared of the real estate sector. And, so we've been in a position to pick up two really interesting real estate stocks this year, and we're hoping that the market will give us more opportunities like that as time goes on.
Okay, well, great. Thank you so much, Richard, for sharing those insights. For Morningstar, I'm Antje Schiffler.